The US dollar comes into this 2018 under pressure and at risk of extending declines despite what has been an impressive run of NFP readings and an unemployment rate at or near maximum employment. If we were to look at these metrics alone, it would be enough to justify the Fed moving forward with a more aggressive path to policy normalization, and yet this has not been the case. While the Fed has indeed been reversing policy, the process has been and is expected to continue to be exceptionally slow and gradual. And so right now, everything comes down to inflation and wage growth, or lack thereof, with no signs of any meaningful pickup on this front. The lack of movement on this front leaves the Fed in a position to stay on the dovish side of normalization, which translates to yield differentials more easily inclined to move out of the buck's favor. This puts the central point of focus in the jobs report on the average hourly earnings component as highlighted over the past several months. Assuming no major negative shocks from the NFP print, the market will be looking to make its decision based on the average hourly earnings. Anything that shows a pickup above forecast would be viewed as US dollar supportive and risk negative, as it would force the Fed into needing to be more restrictive on rates, while anything that comes in on the softer side would likely fuel deeper setbacks in the buck, while possibly inspiring even more upside in risk assets, though as far as higher stocks go at this point, it would be hard to see such an overextended market keep up with this run for much longer. Breaking down the data, NFPs are expected to come in at 188K versus 228K previous. Average hourly earnings, the key highlight of the report, yearly is expected to hold steady at 2.5%, while the monthly is expected to tick up to 0.3% from 0.2% previous. As far as the unemployment rate goes, it's expected to hold steady at 4.1%. These are the lowest levels that we've seen in the unemployment rate since 2000. Participation rate, it was previously 62.7%. Looking at the key levels, Eurodollar 2093, the 2017 high, is the key level to watch. Whether we break it or not, or the fact that we're above it or not, is not of consequence. It's where we close the day. If the market closes above 120.93, well, it could very well set that stage for the next upside extension, exposing the 126 to 127 area. On the downside, 119.37, the December 29th low, is the level that you want to watch. For cable, 136.60, that 2017 area high, and on the downside, we're looking at 134, the figure. Dollar yen, 113.75, the December high above, and 112.04, the December 15th low below. That's all for now.